Welcome to Talking Divorce. Real conversation, real guidance. With Donald Schweitzer and Laurie McShane.
Welcome to Talkin' Divorce. Today's conversation is the beginning of a special two-part series called Home is Where the Heart Is, because when people think about divorce, they often think about the legal process, but what sometimes gets overlooked is the emotional connection to the home itself. For many people, the loss of a transition of a home can feel even harder than the divorce. It's where memories were built, where children were raised, and where life happened. So today, we're having real conversations about what happens when that chapter begins to change emotionally, financially, legally, and practically. Joining us today are two special guests, Janice Cohen, sales manager at Mutual of Omaha Reverse Mortgage Specialist, and Jason Thomas, a mortgage advisor at JMJ Financials. And together, we're going to be talking about what people should know, what options are available, and how to move forward with clarity and support. The home can often be the biggest and most emotional part of the process. And then when you layer in all of the moving parts, it can really seem overwhelming. So, Dawn, where do you see your clients come to you when they have to first start this conversation?
Yeah, Lori, if you know somebody that's going through a divorce, there's a very high probability there's going to be a house involved. And the reason why is that the house is the major asset of most divorces. Okay, and most divorces don't require dividing up corporations, and things of that nature, but the family residence is there. And it creates a lot of litigation. And besides the litigation, it also requires a lot of thinking. What are we going to do when we have to separate? Who's going to keep it? Is there going to be a buyout? A lot of times people make bad decisions as to what they're going to fight for. And then they get into the process that even if I get it my way, how do I make it work? Do I refinance the loan? And then once I get in the house and it's mine and we're already divorced, how do we keep it going? How do I keep living? Are there solutions? Well, a lot of times there's not enough money to go around, but there's some creative ideas. And fortunately, we've got two great guests with us today. We've got Jason, who is a mortgage broker, very talented mortgage broker that's going to answer a lot of our questions, and a lot of our viewers are going to really thank you at the end of this, because we're going to really probe about financing, what the consideration should be, what you look for, what makes sense, what doesn't. And then we have Janice, who's a longtime reverse mortgage broker. And she's going to talk about the possibility that, let's say that you get divorced, Lori, and there's just not a lot of finances to go around. And we're talking about gray divorces, mostly people that can't really start it all over again. And that house is the only asset. How do you make that work? And is a reverse mortgage really meant for you? So that's where we're going to be. And maybe we could start off with you, Lori, but you talk about emotions, right? Emotions when the house go together. Right. It's. I think the name of our program today is what?
Home is where the heart is.
Right.
Yes.
And why don't you talk about that as a mortgage, a real estate agent? What do you see when divorced people come to you about their emotions? Where are they?
They're all over the place, and it's my role to make each person feel like they've been heard, feel like I am following, a set of guidelines, which, I normally set up right from the beginning. And communication is super important, as well as setting expectations up. And then once the parties know what expectations are what of the house and what needs to be done, and that's also including, a set of guidelines of what needs to be done for the house in order to get the proceeds. Because all in all, when it comes down to it, my end game is to get as much money in their pockets as possible, because I know that they need all the funds that they need in order to start their new lives. And if I can give them certain things where they can micromanage just different little tasks, maybe stuff that's not going to be super overwhelming. I think they can focus on the bigger picture and will help them get out of the house. But where I have to be extremely cautious is being neutral through all the parties, because I can't go one way with this person and one way with that. I have to just do what's best for the house. And so even that's my fiduciary duty is to the client. So I have to make sure everybody's on the same page. Everybody doesn't get any special privileges and stuff like that. Just so, it's a system. It's a process of systems in order to make it run smoothly. And then, yes, the emotions, they do come in and go, but that's why we have therapists, right?
Right.
I can't be their therapist, because then, one party may feel, oh, well, you're talking to my wife and this, and that, or the vice versa. So I just, I just stay neutral through the process, and I just keep the motivation on the home to get them to their next chapter of their life, which will hopefully give them like their end game.
Right. And with the issue of a home in a divorce, sometimes we're talking about one person wants to buy out the other person, and that other person doesn't want that to happen. Or they both want to buy out each other, and then they get into the appraisal game. So we could talk about a myriad of issues that pertain to the home in a divorce. And following episodes, we'll go there.
Yeah.
But today, let's really focus. Let's focus on when somebody is trying to finance, first of all. And Jason, could you help us understand what the challenges are in a divorce setting when somebody says, look, I have authority and the court's giving me 90 days to try to refinance the loan. What are the challenges that a party might have in a divorce?
Yeah, thanks, Don. One of the biggest challenges, you're going from previously likely having two people qualifying for a mortgage, right, in this instance, and now that that the marriage is unraveling in this instance, somebody has to try to qualify solely on their own, right? So we're only looking at their income, and there may even be a buyout as well. So the loan amount might actually need to increase to buy out the other spouse as well, and that you're qualifying for potentially a higher loan amount in payment. So that's essentially the challenge, and where a lot of people make a mistake with this is maybe waiting too long to talk to a lender.
Well, let me ask you about
Yeah.
that. When should somebody start talking to a lender?
Right away, more than
right
likely.
at the beginning of the divorce, even if
Yeah.
they don't know that they're going to get it?
I mean, it's helpful, to at least get pointed in the right direction as far as what steps you need to take. You may not have the exact numbers yet that are required for it, but a lender can give you an idea based on what the fair value, appraised value of the home is at the moment. If you have an idea potentially of what the buyout might look like, you can at least start talking some basic numbers to see if it even makes sense. But essentially, you kind of need to treat the situation as if you're buying a home, as if you don't already own it. Like, look at it as I need to get pre-approved to try to refinance is how it should be looked at.
Right. And when you're refinancing, because you've got to pay an equalization payment to the other side, meaning you've got to pay them one half the value, how does that play into the equation?
Yeah, let's just as a quick example to keep numbers simple, let's say a home's worth $1 million and there's a $500,000 outstanding mortgage, so there's $500,000 in equity, and this is what the court has determined through an appraisal that the home's worth. You need to pay your ex-spouse $250,000 on top of what's still owed, right? So depending on, again, what's ordered with the court, right? So the loan amount might actually be increasing, potentially up to $750,000 if the court decides that you're liable for the remaining current mortgage as well. So the mortgage amount's going up, the payment likely is going up. Depending on what rate it was locked in at previously, the rate might be going up as well. So there's a lot of things that you really need to check.
That's happening a lot nowadays, right?
Especially now. Yeah, right now.
Yeah, you get a couple that's been in that house for 20 years.
Yeah.
They've probably managed to get their interest rates low.
Yeah.
Now they're somebody's refinancing it, and it might not be the perfect time, right?
If somebody's been in a home for more than, call it 5 years right now, they probably have a pretty low interest rate just because of how low rates were during COVID, right? Everybody was refinancing their mortgage if they could back then. And even before that too, I mean, if somebody didn't do it then, we had a long string of years of rates that were a lot lower than they are right now. So there's potentially a pretty large payment shock.
Yeah.
Yeah.
So you're looking at one of my clients. She's been lucky enough to convince a court that she could keep the house and she could refinance the mortgage within 90 days. She starts filling out the application. What are you looking at as far as her financial ability in order to say, yeah, I think that loan will carry?
I mean, it's no different than if I'm, pre-approving somebody to purchase a home or doing a standard refinance, right? I'm going to look at, what income, she has, whether that's, if that's a full-time job or whatever.
Does that include spousal support?
Yeah, that's what I was getting at. So on top of that, what's ordered through the courts, through this divorce?
I always find that interesting. Right? Let me find that interesting because spousal support is nice to have, but it's not always a guarantee, because what happens if you got some fool out there that just want to pay his spousal support? Does that come into play at all, or is that just considered regular income as if there was a job?
Yeah, well, I mean, if they're not paying it, that's one thing, right? So I guess it depends on where in the process, the history of it,
okay, and
then the history beyond as well. We're going to be looking for at least 36 months remaining on the support that's being paid, whether it's spousal, whether it's alimony or child support.
Oh, you consider child support as well?
Mm-hmm.
Oh, okay.
Yeah. Yep. As long as there's 3-year continuance beyond the note date of the new loan, right? So if it's something where, if a child's 16 and there's only 2 years of child support, depending on the loan program, you may not be able to use that income to help you qualify. But if there's at least 3 years continuance, then you can.
Okay.
And oftentimes, if it's not taxable as well, you can actually gross it up an additional 25%, which is helpful.
Explain that. Can you explain that a little bit?
Yeah.
I mean, I know what you're talking about. Our viewers might not.
Yeah. So if, let's see, simple numbers, let's just say child support was $4,000 per month and it's all non-taxable. Take 25% of the $4,000, so that's another $1,000, and I can use $5,000 as the qualifying income, even though they're only receiving $4,000.
Oh, that's good.
Yeah.
Very good.
Yeah.
Okay. So, Janice, okay, you are faced with the opposite end of a divorce, right? You're at the tail end. You have a gray marriage being people like me, a baby boomer, who not these two folks here.
Right.
So thank God for you. So anyways, a great divorce, and she just barely makes it, and maybe there's some Social Security, and she wants to keep the house and she's attached to it, and maybe not the best financial decision, but is there a way to save her from not having to give up the house?
Well, yes. And so when we are talking about using a reverse mortgage to enable the spouse who wants to remain in the home to buy out the departing spouse, if they're over the age of 55, we can help. I have a scenario right now.
Okay. Why over 55?
Well, we have a program at Mutual of Omaha where our minimum age is 55 to qualify for a reverse mortgage.
But I'm going to ask you, what's the policy behind that, though? Is it because...
Yeah. Well, we look at amortization tables,
Okay.
In the same sense that an insurance expert would look at actuarial tables. So we assume optimistically that this borrower could live till the age of 100. So where would the loan balance be vis-a-vis the home value at that time? And we do try to mitigate a situation where, we wouldn't want someone to necessarily take out all of this money and, if they and end up
for it not to work out.
For it not to work
Right.
out, or they're underwater very
Yeah.
quickly. When we look at the numbers on a reverse mortgage, the younger the person who's borrowing is, the less money we can lend them.
Ooh.
If someone comes to me at 55, let's say the average home value that we can lend on would be maybe about 50% of the home value that we can lend on. If a person is 55, we're probably looking somewhere in the 45% range. If someone's in the 80s or 90s, we may be looking at up to 60% of the home value that we can lend. So right now, I have a divorce situation. Home value is...
No names, please.
No names.
Okay, go ahead.
None. Nope. Home value is approximately $2 million. There is a $500,000 mortgage on the house. Now, mind you, a $2 million home based on the borrower's date of birth, and it's the husband who wants to remain in the house, by the way. So based on the husband's date of birth, we're going to be able to lend approximately 50% of the home value. So the first order of business for us as a reverse mortgage company is we're going to need to be able to extinguish the existing mortgage. And that's going to benefit both members of the couple. And then it's going to be in the asset column of the departing spouse as well, to have that loan forgiven. And then we'll have $500,000 that we can give to our borrower. Not to, well, we could give it to the spouse if she presents us with a demand letter. Or we can give it to our borrower, who's going to be our sole borrower, and then he can make arrangements to...
So I think we need to simplify this.
Okay.
So who's the borrower, who's the spouse here? Are you talking about husband, wife still,
Husband.
Right? Okay, so let's say in your hypothetical, as in your case, you have the husband as a client.
Yes.
Okay, and you're saying somehow the wife could wind up with the money?
Well, yes. I mean, obviously, we would have to go by whatever they've agreed upon, and it seems to be a fairly amicable divorce.
Should I die, you're going to get the rest of it? That's
Yes.
everything. Okay.
Yes.
Okay, something I'd rarely see, but go ahead.
Exactly. And in fact, they normally in a divorce setting, if we are going to quit claim the departing spouse off title, which we can do even if there isn't a final decree of divorce. But I will say, if we go into a reverse mortgage with the departing spouse wanting nothing to do with the process, then we would need to have a final decree of divorce before we even begin. But in the case that I'm working right now, there is no final decree of divorce, nor will there be until sometime after the funding of our loan. So the money that will be realized by the reverse mortgage will be a tool that can be used to settle the final divorce terms.
Oh, part of the equalization payment then.
Exactly.
Interesting.
And not only that, but it does appear that part of what will happen in my current situation with this couple is that the $500,000 that he would have available to him to buy out his departing wife will not be sufficient to accommodate the terms of their divorce, but he's also willing to go into his retirement account and liquidate some of that to fill the gap. So they're being very creative as a couple to figure out a way to make this work, because his first and foremost priority is that he wants to remain in the house.
Sounds like people are being nice to each other for a change.
They really are.
So let me ask you this though. So if I understand it, the wife is saying you could keep the house, right? Now this could be contingent on you paying my equalization payment,
Yes.
but it sounds like it's going to be a deferred payment.
Yes.
So when you pass, then I'm going to get paid.
Yes.
Is there going to be interest attached to her? Well, I don't know if you'd be even in the loop for that or not.
Well, when a person does a reverse mortgage, there are no payments expected or required. As I was listening to you, it's so different. My experience is so different than yours. You're looking very seriously at the income. My borrower, who came to me several months ago, wanted to know, based on his Social Security alone, does he qualify? And of course, he does have a pretty robust Social Security income, so he will qualify just based on the Social Security alone. That's the only income we are going to really need from him.
Interesting.
And the reason for that is that there are no payments expected or required on a reverse mortgage. So he's taking on the utilization of the equity in several ways. He's utilizing equity to be able to extinguish the mortgage that they currently have. He's utilizing equity to be able to fund the terms of their divorce, the equalization payment. But he's also utilizing the equity to be able to remain in the home knowing that it's going to be a growing loan balance over time. So how much equity will be left in the home in 10 years, in 20 years is very dynamic. And I say it's dynamic because, number one, we're using an adjustable rate mortgage. That's number one. I mean, we could end up looking at the fixed rate mortgage as well. We do have a multitude of programs that we can offer. But in some cases, it may be advantageous to use the adjustable rate. Plus, the other dynamic, of course, is what's happening to the home value. Now, we always, when I share documents with my prospects and with my clients, we always assume an annual appreciation rate of 4% per year. But we know very well here in California, that's not a very realistic appreciation rate. We appreciate much higher here than in Ohio or Mississippi, other parts of the country where the home appreciation is not quite as robust. So it's, even once someone does a reverse mortgage, it is a very dynamic kind of a loan. People do receive statements every month, so they always know where they stand in terms of what their loan balance is.
But they don't have to pay it.
They do not have to make payments. What they do have to do is to continue to pay their property taxes and their homeowners insurance and any HOA fees. They have to maintain the house to the extent where neighbors aren't calling the city and complaining, which I've only had happen one time. And then the other thing, of course, is that once a year they'll receive an occupancy affidavit asking, is the home still your primary residence? They need to fill that out, sign it, send it back, and then their loan will be.
That sounds like a good deal for some people.
Definitely.
So you're talking about this process of basically living off of the equity of the home.
Mm-hmm.
Does it come in one lump sum payment or is it monthly installments? How does it go?
It can go a multitude of ways. So some people want their mortgage paid off and then they want to receive monthly payments. Some people have no mortgage and they just want a line of credit. I've had people come to me and say, I don't have long-term care insurance. I just found out that I'm not eligible because I have type 2 diabetes. And I'm really worried because my kids are not going to be moving back in and helping take care of me in my old age. I really need to have some funds to make sure that should something happen to me, that I can afford to pay someone to care for me in my home where I want to be. So there's that. And in many divorce cases, if there's a mortgage, the purpose for the loan will be to extinguish the existing mortgage and to use the rest to settle the terms of the equalization payment, so that we'll be able to do a buyout of some sort.
Is there anything prohibiting somebody from taking this lump sum amount that's left over after the mortgage has been paid, from saying, now I'm going to invest that money and live off and try to make more money out of it?
Well, it's interesting. I have had folks come and say, to me, I'm going to take this money and I'm going to use it to buy some
Vegas.
No, oh gosh. I'm going to buy some laddered CDs. You can do that. What I try to do with them is to review that plan alongside the amortization table and say, what if you were to just take monthly income or a line of credit with the remaining equity? Where would you be in terms of the equity stake that you have in the home in instance, example 1 and example 2. And very often they find that they'll have a lot more equity at the end of the day and a lot more flexibility in terms of what their next chapter might look like if they do a line of credit or monthly income versus taking a lump sum and investing
Could
it.
be dangerous, risky. It seems like
It
risky.
could be risky.
So speaking of financing, Jason, sometimes people say, look, I want to keep the home. I don't want to pay at the current interest rates. Is there any way that we could finagle this where I can assume the loan or do something, in that regard? Is there such a thing?
I mean, not really. More than likely, you're already on the loan, so you're not assuming it.
Okay.
Right.
Well, I don't want.
but-
he doesn't want to be on the loan.
Yeah.
I want to stay on the loan. He doesn't want to be on the loan. Is there a way that we could finagle that?
Yeah. Most of the time, I mean, you might be able to work something out with the servicer, but if the terms of the loan have to change at all, if the loan amount has to change to pay out the X, anything like that, then no. You're going to have to redo the loan completely. If it's a conventional loan, there's no assumptions anyway that are allowed for those loans. It's only for government loans like FHA and VA. One of your reverse products is an FHA, is a HUD product. So maybe you could speak to that as well if there's any sort of option there to just remove the borrower potentially. But if anything, if there's any sort of buyout that has to be done, then more than likely not. And if it was allowed, you still would, at least for me, the one borrower would still need to prove that they qualify on their own to continue paying that mortgage regardless.
A viewer wrote in a medical expense question. How are children's medical expenses typically handled in divorce cases? And what happens if one parent refuses to pay for the other?
Okay, so well, first of all, it doesn't matter, Lori, when the injury occurred. It doesn't matter whose custody it was when the child had an accident. The fact of the matter is that the California Family Code mandates that both parents are responsible for the children's health medical bills, and even if there's no insurance, they both are responsible. Now, going to your second question, which is what happens if somebody doesn't pay?
Yeah.
That's called contempt of court, and it's one of the easiest things to prove up, and it's really a great remedy, for people that want to shirk their responsibilities with regard to taking care of kids.